Let's just do a couple of questions quickly. Just make sure you've got this whole idea of comparative advantage, etc. right. We'll get progressively more challenging as we answer these questions. So first of all, choose the correct option. There's 5 questions. Have a look at, 5 options. Quickly have a look at that and tell me what you think the answer is. Take 10 minutes quickly. Okay, what's the answer? A, you happy with that? Even if one country's got an absolute advantage in 2 goods, there's still the potential for gains from trade. June 2014. Okay, there's another one. Consider a world comprised of 2 countries, A and B, producing 2 goods, X and Y. Country A has an absolute advantage in the production of both X and Y. Which of the following statements is or are correct? Okay, I'll read those. Okay, so the answer to this question. What do you think? Does country A have a comparative advantage in both? There's nothing there that says that it has a comparative advantage. All it has is an absolute advantage, which doesn't mean that it has a comparative advantage. And in a world of 2 countries and 2 goods, as the discussion we've just been having is, you can't have comparative advantage in both. There are mutual gains from trade if they each specialize in the good that they have a comparative advantage in. Is that true? Yes. Country B should stop production of X and Y and import from A. No. Because it'll have a comparative advantage in one of those 2 goods, and that's the thing it should produce. Okay, so here we've got an example with 2 goods in 3 countries. I'll read it to you and then you can answer. Greece, Italy, and France can each manufacture either wine or cheese, or both wine and cheese. Using the same inputs, the 3 countries can produce the following combinations if they specialize in the production of only one of those goods. Which of the statements below are correct? Does Greece have an absolute advantage in cheese? Could Italy gain from trade by exporting wine? And can Greece gain from trade by importing cheese from France? So, work it out. Okay, let's go through each of the answers. First one is very straightforward. Does Greece have an absolute advantage in cheese? I expect like a resounding, everyone should be able to answer the first one. Does Greece have an absolute advantage? Anyone got a problem with that? No? Great. Can Italy gain from trade by exporting wine to either Greece or to France? Yeah? So how do we tell? We're going to work out what the opportunity cost of producing wine is in Italy. What is the opportunity cost of wine in Italy? 1/3 of a piece of cheese. And what is the opportunity cost of producing wine in Greece? 2 pieces of cheese or whatever it is. 2 tons. And in France, what's the cost? 3 tons of cheese, yeah? So where's cheese the cheapest? Where's wine the cheapest? In Italy. So can it gain from trade no matter whether it exports to Greece or France? Yes. And then Greece could gain from trade by importing cheese from France. Is that true? Okay. So what was the price of cheese in Greece? What's the price of cheese in Greece? Half a litre of wine. What's the price of cheese in France? 1/3 of a litre of wine. Where is wine cheaper then? In Greece or France? Cheese. Where is cheese cheaper? In Greece or in France? In France. So then Greece could gain by importing cheese from France. Okay, question 42. Yeah, you got a production possibilities frontier. South Africa trades with the rest of the world. The international terms of trade are 1K is to 2C. South Africa should produce at what point? And if South Africa wishes to consume 65k, then what amount of C will it be able to consume on petrol? Well, how about this? Okay, Ben, what do you think the answer is?
I think it's
Answer E. Okay, so to anyone else, you know Ben's reputation. See whether you get the same answer or a different answer. And then decide how confident you are. Shall we go through it? Do you want some more time, or should we go through it? Can we go through it? Okay? Are you guys ready? You want to go through it? Okay, so if South Africa trades with the rest of the world, the international terms of trade are 1Ks to 2C. What that means is South Africa can buy 1K for 2C, or alternatively, it can buy 1C for half a K, right? So when it produces, it should be saying, okay, I shouldn't produce capital if it's going to cost me more than 2C, correct? And I shouldn't produce C if it's going to cost me more than half a K. You happy with that? But as I move along that production possibilities frontier, remember, as the price of C gets cheaper, the price of K gets more expensive. Or as the price of K gets cheaper, the price of C gets more expensive. Right? As we move along that production possibilities frontier. You happy with that? In other words, as I produce more and more and more K, I'm giving up more and more and more C. Which means the cost of K is getting more expensive. Okay? Whereas, as I'm going that way, if the cost of K is getting more expensive, the relative cost of C must be getting cheaper. As I'm producing less C, the cost of C is getting cheaper. And if I go the other way, as I'm producing more C, the cost of C is getting more expensive, which means I'm producing less K. As I'm producing less K, the cost of K is getting cheaper. That's what diminishing or increasing opportunity cost means, diminishing marginal return. Okay? Which means there's only really one point that I should be producing, which is at the point where 1K costs 2C. Because if I produce at any other point, either I'm producing C too expensive or I'm producing K too expensive. Is everyone following me with that logic? I'm really getting very minimal feedback. So I'm going to assume yes, and you're just thoroughly bored. Which means, at what point does 1K cost 2C? It is at the point where South Africa is producing C equal to 40 and K equal to 80. How do I know that? Because 40C, in order to produce 40C, I'm giving up 20K, which means that the price of C, 2C is 1K. So 40, 80, so it looks like the first part of your answer is correct, option E. What about the last part? Okay, if I'm producing 40C and I'm producing 80K and I want to consume 65K, that means I've got 15K that I can trade away. If I trade away 15K, how many C's will I be getting? 2 times 15, 30. How many am I producing? 40, 40 plus 30, 70. Option E, looking good. Given the lack of feedback, I'm going to assume that you know exactly what's going on, and I'm going to move on. Unless someone actually says something to me that I can translate into something actionable. Yeah. 71. Okay, happy that they're producing 40 and 80. 40C, 80K. And they want to consume 65K. They're producing 80, how many are they consuming? They want 65. How many can they give away? Or trade away? 15. They trade away 15K, what will they get for 15K? They get 2C for every K, right? So So they give away 15, they trade away 15, how many seeds do they get? 15 times 2, which is how many? 30. How many are they producing themselves? 40. They're producing 40, they're getting 30, how much do they have in the end? You happy with that? Okay, any other questions? As I said, either you're entirely bored or so confused that you don't even know what questions to ask in each case. Not much I can do. Okay, so we understand that there are benefits to trade, that countries trade with one another because it's beneficial to them, right? And so trade then generates exports and imports. What we've primarily spoken about, or in the examples that we've used, is trade in goods and services. But in fact, countries trade more than just goods and services because there are other things that cannot leave countries that other people in other countries still want. In other words, if there is a factory in South Africa and a company from like Brazil wants to buy that factory, they can't pick the factory up and take it to Brazil. And in fact, they probably don't want to take the factory to Brazil because what they really want is the factory in South Africa, right? So what they will then do is buy the factory from South Africa. But buying the factory doesn't mean that the factory leaves the country. What leaves the country is the ownership of the factory. In other words, if we think about companies, the ownership of a company is represented by the shareholder. If you own a company, you are a shareholder. So apart from just selling goods and services, countries also sell shareholders. You have that idea? They sell ownership of assets that are in the country. Apart from that, governments can also sell bonds. South African government can borrow money from the Brazilian government or from people in Brazil by selling bonds to Brazilians, right? So apart from goods and services, we also trade in financial instruments, any kind of financial instrument. So there's a lot of different trade happening. What we want to do is we want to say, okay, let's keep a record of this, or when we keep a record of this, what does that record look like? So the first thing I want to talk about here is balance of payments. So what is balance of payments? Balance of payments is a record of international trade transactions. That's what we call that record. It's called the balance of payments. So if you ever hear them talking about it on the radio or on TV about the balance of payments, then you know it's about trade between countries, keeping records of it. So how does the balance of payments work? Balance of payments is basically a big accounting exercise, as you can imagine. And what we do in those accounts is we will credit that account if payment is received from a foreigner, and we will debit an account if payment is made to a foreigner. That's the simple side of it. I mean, obviously the problem with accounting is, well, not the problem, the genius, I suppose, of accounting is that any credit must have a debit as well. Everything must match. So what happens is, if we make a payment, if we credit the balance of payment, so a payment is received from foreigners, that's the same as saying that money is coming in. That's why it's a credit. So credit money in, we must also debit something else. What we actually end up debiting is usually the reserves account or something called other investments. So there's a bunch of different accounts that we look at, and we'll get to those accounts. The two important accounts, in fact, there's only the two main categories of accounts are the current account and the capital and financial account. So the capital account used, I don't know the exact story, something like the capital account and I think the financial account used to be separate accounts. I think, or we used to have something called the capital account, and then the financial account was, I think, had a different name or something. Anyway, but now you've just got two. You've got the current, and then you've got another account called capital and financial. So what do those accounts do, and how does it all work? In your current account, you have a record of all the trade in goods and services. Whereas in the capital account, you have all the trade in like those financial derivatives that I was talking about. So if countries sell bonds, if they sell share ownerships, anything like that, then that goes in the capital and financial account. Any goods and services gets recorded in the current account. Okay? So the current account is a trade of goods and services, and what tends to happen here is if you have an export, then you will be crediting the current account. If you have an import, then you will debit the current account. But again, because this is accounting, when you credit exports, there must also be a corresponding debit. And that debit will actually end up being in the capital account under a section called reserves or other investments. In other words, and I'll just sort of guide you through a discussion of it. And this whole thing is really accounting messy stuff, right? If you are good at accounting, then you know how messy accounting is. It's just like you got to follow each step. And I'm not good at it, so does my brain. So if you want to export, if we are South Africa and we are exporting goods, what are we doing? We're sending goods out and people are paying for those goods. They're giving us money for those goods. Okay? So we credit that account because that's money in, goods out. Where did money come into the country from? What account? From an export account, from the current account. Okay? So we credit the current accounts, goods go out, money comes in. But where does that money, remember, for every credit, that money must go somewhere. Where does that money come, where does it go after it comes into the country? Depends how they paid for that stuff. Generally what would happen though, the process is, let's look at it easily, an easy example. If they're giving us money, what money are they giving us? They're probably giving us, let's trade with say the US. The US uses dollars. What are they going to buy our goods with? Dollars. They don't have rands because rands are out there. Okay? So they would have to give us dollars. And where do those dollars then go? They go and they sit in what we call foreign account reserves. It's reserves of foreign currency. So with credit exports, we would be debiting reserves. We now hold foreign currency. Except that that's not actually how it really works, because the way it really works is the following. If I'm someone in South Africa and I'm exporting my goods to the US, what happens is when I give my goods out to those people in the US, I get paid into my account here in South Africa in rands. That's how it works. So how then does that guy in the US get rands to pay me? So the guy in the US has to take his dollars. He sells his dollars to the Reserve Bank. The Reserve Bank takes those dollars and puts them into the reserves. Now they've got US dollars. And what do? They give rands to the guy that wants to buy my goods. He then takes those rands, he pays me, I give him the goods. I now have rands in my bank account. So you see, the end, what's happened is money, South African rands have gone out of the country and then they've come back in again. Right? In the meantime, South African goods have gone out of the country and US dollars have come into the country. So you can see, we credit the exports and we debit reserves. Even though the guy who sells the stuff doesn't get the dollars, right? What happens in between is the guy sells the dollars to the Reserve Bank gives the money to that guy that gives rands to the guy who's buying from me, the guy who then buys from me gives me the rands and I end up with the rands. So the country has rands, they go out and then come in again. Yeah?
When they say increases, the current account increases or decreases like they do in the tax, are they referring to, what is the current account then? Is it the net, because what I understood initially was that it was that the current account deals with the goods and services as in inflow of goods means it's increasing, outflow means it's decreasing. But it sort of behaves like income and expenses in a sense. So like they called it a surplus when exports were greater than imports, which makes it sounds completely
so we'll get to that terminology.
Okay.
So that's why I say it gets really, it's like a messy thing because it's accounting but it's trying not to be accounting. Or, no, it's not trying, what can I say? So, it's trying to say what happens without using accounting terminology. But we're using accounts, and so it gets a bit confusing. Okay, so in other words, so we credit exports, and then let's look at the other side. What about if we want to import something? Then we would debit our current account. What's happening when we import? We've got goods coming in and money's going out. So there's two ways that we could work that out. Let's assume that first of all we exported something, so now we have US dollars in reserve. Okay? Now we want to import stuff, and we want to import it from the US. What do? We can take those reserves, give them US dollars, and then they give us goods in return. Now we've imported. If we imported the same amount as what we exported in terms of these US dollars, are you happy that we would have had reserves come in and then those reserves went out? So the balance in the reserve account now is 0. But we've credited exports and we've debited imports. That's what's now left on our balance sheet. Credit of exports and a debit of imports. You happy with that idea? The way that it obviously actually works in reality is I'm the guy now that I want to import something. I must go to the Reserve Bank. I buy those dollars from the Reserve Bank. I give them rands. The Reserve Bank I give rands to the Reserve Bank. I then take those dollars. I give those dollars over to the US guy. He gives me the goods. At the end of the day, me, the South African, I've imported goods and I've paid for it in rands. I paid for it in rands to the Reserve Bank and I paid for it in dollars to the guy outside. Okay, so there's a lot of flow. There's flow of money and flow of goods. And the way the textbook describes it, it kind of just ignores the flow of money side of things, which makes it difficult or complicated or confusing if you're used to accounting. In which case, if we've got exports and imports matching each other, we've got a debit and a credit, and it looks fine. Okay? But what happens if those debits and credits don't match each other? What else is happening? The textbook doesn't explain it. What's happening is it's either a change of reserves or a change in some other financial derivatives that are paid for this discrepancy. So, to come back to your question. The terminology that we use when we're talking about balance of payments is, first of all, understanding what net exports is. Net exports, we're happy that that's exports minus imports from our aggregate demands discussion before, right? Now, a trade surplus, which is also called a balance of payment surplus, which is a surplus on the current account, means when exports are greater than imports. Okay? In other words, if we have positive net exports, we would have a trade surplus. Okay? Yeah?
So does it seem like that the current account increases with exports, not with imports? As in, it's because by the wording of the cut, I'm just going by that, they say that there is an increase in and then or a decrease in, and then you have to choose between current and capital. Okay. And it's difficult to tell what's increasing when they're selling more goods, because current account does it not look at the goods themselves within the country, not the money going in and out. Yeah, okay, so let's talk, come back to that question again after we've spoken also about the capital account. Okay, so let's take this for now. So trade surplus would be if exports were greater than imports. Okay? In other words, if the value of credits in the current account was greater than the value of debits in the current account, we would have what's called a trade surplus. Alternatively, we would have a trade deficit if imports were greater than exports. In other words, if the value of debits was greater than the value of credits. But, and this is the thing, that trade account is talking about the movement of money with those goods, right? But it doesn't tell us how we financed that trade. Okay? In other words, financing a trade deficit or a trade surplus, okay, has to be done through the capital account. So a trade surplus would be financed by a deficit on the capital account, or a trade deficit would be financed by a surplus on the capital account. Okay, so we will just talk about the capital account in a moment.
in South Africa's context, what we have is a trade deficit. We import more than we export. And the way that we finance that is with a surplus on the capital account. So what does that mean? So I'll come back to this in a moment. Well, the capital account is the trade of immovable objects. Okay, in other words, when it's a trade of assets or ownership of stuff, and the trade of any other kind of like financial derivatives, products. So if you are selling bonds, then you are selling not direct ownership, but you're selling a share of the productive, can I say, the productive profit of that output. In other words, if you're selling a bond to someone, then you need to repay them that bond, right? And you would repay it by generating some kind of income in the country. So when you sell a bond, you are selling a share. I use the word share, but I don't mean as in an asset share. You're selling that future income stream to someone else. So any kind of other financial products go through the capital account. So when we talk about net capital outflow, and this is, again, complicated stuff, what we mean is that the net local purchase of foreign assets minus the net foreign purchase of the net local purchase of foreign assets less the net foreign purchase of local assets. In other words, what we're saying is net capital outflow is when we have the stuff that we bought from them minus the stuff that they bought from us. But not physical goods. This is now financial assets. Okay? And again, it's debits minus credit. Okay? And we call that net foreign investment. So let's now go back to the idea of financing the current account with the capital account. So what we're saying is that if we have a trade, start here with a trade surplus. We have a trade surplus, it means we are exporting more than we are importing. Okay? If we are exporting more goods than we are importing, it means that we are getting more money in from foreigners than what we are giving back out to them. Right? And if we're getting more money in, what we are holding is a financial asset, right? Whatever that financial asset might be. What we could do, as an example, like the way the Chinese do it, let's talk about China and America, because that's nice. America runs a deficit. They import more from China than what they export in terms of goods and services, right? So, goods and services go from China to the US. Money goes from the US to China. What does China do with those US dollars? They give those US dollars back to the Americans and buy US Treasury bonds. So when the government in the US needs to borrow money, they sell their bonds, they sell the bonds in the open market. The Chinese take the dollars that they've got from the excess exports and they buy American Treasury bills. Okay? In other words, American bonds. And those bonds are now a financial instrument. You happy with that? It's not an actual good or a service. It's just a piece of paper that says you owe me money. It's a record of debt. Okay? So that extra money that the Chinese get from the US, they then use to buy American assets, financial assets, right? In other words, if we're talking about the United States has a deficit on their current account, which is financed by a surplus on the capital account. The surplus in the capital account means, in the Chinese terms, that the Chinese are buying more assets from the Americans than what the Americans are buying from the Chinese. So it's, in a sense, this is what's happening. Americans are swapping American assets for Chinese goods and services. Yeah?
So then do the two surpluses coincide?
No, not two surpluses. There will be a deficit in the current account, is a surplus on the other account.
But why? Because surely if you exporting more, so the other one's going, your current account is going up, your surplus is increasing. But if you're exporting more, you're getting more money to buy those bonds, which means that your capital account's also increasing. So are they not both either increasing or decreasing simultaneously?
Because the one's debits and the other one's a credit.
Yeah.
Right?
No,
So if you've got a deficit in your current account, it means that your credits are greater than your debits. Right?
Yeah, okay.
Which is financed by a surplus in the capital account, and the surplus in the capital account is when the debits are greater than the credits. So the credit in the current account is matched by a debit in the capital account.
Okay, that
Right.
makes sense. But then don't their definitions align though?
So then what we would have is a trade surplus matches a capital account deficit. Right? You happy with that idea? Okay, so if we're talking here then, if you've got trade surplus, is that what the type question was? I don't recall.
No, it was more the concept of increasing. What is increasing?
Okay, so an increase in the current account means that your exports, the surplus, exactly.
So how can you not, if your exports are greater, so you distributing more goods and services, but by that definition your trade surplus is increasing. Then in your capital account, is it not simultaneously?
What, again, I'd have to look exactly at the question, because was it saying that the surplus was increasing or the deficit was increasing?
The current account was increasing, which is a bit confusing, so I'm assuming it means surplus.
Yeah, I'm a little bit in the dark, so I'd have to check it out. We can do it just now, because obviously we can check the touch just now and we can talk about it. But otherwise, the other stuff that we've spoken about, does the other stuff make sense? Okay, now, if the Chinese government was not buying those treasury bonds from the US, it would otherwise have just this massive reserve of US dollars sitting as a debit in its capital and financial account, just money owed. Okay? In which case, what has happened is the credit for the deficit in the current account to the US is matched by a debit in the capital and financial account. Yeah. No, the US has a deficit on their current account because they import more. So what they do is they get goods from the Chinese, and in exchange for those goods, what they give is financial instruments. So the Chinese then, they have a surplus, they export more, right? So they've got a credit on their current accounts, and they've got a debit on their capital accounts, which is the US financial instruments, whatever it is. If they hold it in dollars, then it will be in reserves as a debt. But normally what they would do is buy treasury bonds, and then they would credit the reserves and debit treasury bonds, which is still capital accounts. Well, question.
For the US
Yeah, no, okay, so S is asking a really, really pertinent question, which is the following. think about it in your own sense, right? Is it better for you to finance your lifestyle with debt, right? Or to live within your means and finance it by like income or something along those lines? Which is better? In other words, is it ever good to borrow money? When is it good to borrow money? The general kind of financial wisdom would be you borrow money if you want to finance investments. Because with that borrowed money, you're now creating assets which will in the future lead to income which can then pay off your debt. If you're using debt to finance current consumption, all that means is you're consuming now and you've got a great now, but in the future you now need to pay that back, right? And your future is crap. Okay? So what the US is doing is financing current consumption by selling debt instruments to the Chinese. Is that a good way for the American economy to go? So the first question would be, well, what kind of goods is it importing from China? Is it importing factory goods, like machinery and stuff with which the Americans can be productive? The answer would generally be no, they're importing shoes and t-shirts and the normal, what you would call Chinese junk, right? That low-level consumer stuff, and they're paying for it with debt. Is that a good way to do it? That's the question. I'll ask you. Is that a good way to do it? I don't know. But let's end it there. And you want to just come and take a look at that tough question and see exactly what it's all